Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is part of that effort. We're changing up the structure a tiny little bit. We're changing the partner meeting to focus on Phuong and Mike's content. So we'll be covering startup business insights and tech trends and kind of macro trends around what's happening in the venture space. And we're peeling Chris off to do his own segment where we're doing deeper dives less frequently on markets and global macro. Recently did his coverage of his experience in China. I thought that was a really good episode and piece. If you haven't listened to that, highly recommend you dial back and listen to it. So today we've got Mike and Phuong. I think it's a great conversation. We touch on a little bit of Latin America. We touch on bootstrapping versus raising capital and how to do it. Hope you enjoy. We've got Iron Phuong Ireland here today. She's the toughest on the team. She has a cold, and she didn't let it stop her. She's here to give us some insights. What do you got, Phuong?
Thanks so much, Mark. I know I normally can troop through a lot of illnesses, but I got taken down this time. So hopefully I'll make sense today. But today I wanted to talk about a topic that not a lot of investors talk about for obvious reasons. I wanted to talk about how to bootstrap your startup and things to consider before doing so. And if you decide to do so, how to go about doing it. So first off, just a reminder that bootstrapping means building and growing your business without external funding. So this means you're relying on your own resources to fund your startup. So your personal savings, revenue from the business, or loans. That sounds hard. Why would anyone want to do that? I think the obvious reason is you get to maintain full ownership of your company. So you have no one to answer to, and there's more for you in case of an exit. But there's some other really compelling reasons too why you might want to bootstrap. One is that it forces you to get good fast. So you're scrappy, you're resourceful, you're figuring out stuff on your own. So this might help you discover skills that you didn't know that you had. Two is without investors to appease, you'll have more control over the direction of your company. If you want to try a different product design, to shift your business model, completely change where your company is headed, you don't have to worry about getting approval from anyone else. Thirdly, it forces you to focus on profitability. So when you don't have outside money, you're forced to generate revenue as early as possible and become profitable as soon as possible. This will make you focus on building a strong foundation that can help you develop more sustainable growth. And then lastly, it makes you more attractive for future rounds of funding. If you're able to bootstrap your startup to a few $1 million in revenue, it's going to attract a lot of investors with more favorable terms for you. So, obviously there's some drawbacks. It's riskier personally. You have limited funds, which means you're growing more slowly. This could be more risky if you're in an industry where your competitors are well-funded. And then you don't get access to the mentorship and the connections that investors could bring. But if you decide this is the path for you, here are some tips on how to do it. First, figure out how much money you need to get started. Think about how much money you need to live, how long you can be without an income. Maybe don't quit your day job yet. And then think about the costs of building the business. Is it just your time? Do you need software? Do you need services, equipment? How much money will you need monthly to keep things going? And then figure out how you'll cover those costs. Are you dipping into your savings? Are you taking out loans? Tip number 2 is get a co-founder. I know I've talked about this in the show before, and it's always an important decision to make, regardless of how you're financing your company. When you're bootstrapping, it might make even more sense to seriously consider getting a co-founder, because you're spreading out the work and the financial risk. Choose a co-founder with complementary skills. That way you're covering off a lot of the work. And then together, learn as many skills as possible so you have less work to outsource. Next tip is that all the traditional principles of a lean startup are more important now than ever. So validating your business idea, building a streamlined MVP, testing and iterating your product to reach product market fit, all these things need to be done diligently here so you're not wasting your resources. Tip number 4 is to identify your ideal customers and start with a focused niche that you can talk to and market to efficiently. The key here is fewer but more loyal customers that bring in cash consistently and don't cost too much to service or acquire, it's going to be more valuable than talking to a larger set of disparate customers. Build this audience before you even launch, and then identify the right marketing mix to reach them. If you have a small, concentrated set of customers, it's going to be more obvious how you get to them. So number 5, invest where it's important. So it's great to do a lot of stuff on your own, but when something is really important and you don't have the skills to do it, outsource it. A good example of this is branding. So this is where, you can really differentiate yourself in the marketplace. It's a key buying factor in both B2B and B2C businesses. And it's not a skill that many people have. So this would be one place where it'd be actually good to spend the money. And then lastly, track the right KPIs and avoid vanity metrics. You really want to understand how your business is performing. And so you should focus on the numbers that really matter. Sales, conversions, lifetime value, these are essential to look at. It's great that you're growing your social media following, but how many sales leads or sales dollars are coming from there? That's what's really important. And then there's all the other obvious stuff, right? Like minimize your expenses, track your burn rate, don't hire too quickly. All that becomes even more important here. And that's it. Those are my tips.
That is a great topic. This is near and dear to my heart. At Interplay, we have started and invested in lots of high growth venture-backed tech companies. But I don't know if everyone knows, but we've also bootstrapped about a dozen companies, a lot of which have worked out. And the way we typically bootstrapped was a little bit of partner capital, but also mainly through revenue, just getting to revenue really quickly, even before we set up a lot of expense infrastructure. The pros and cons of bootstrapping are not valued. The pros are not valued enough by most people. I think it's really a terrific way to go. The maintaining ownership really is a game changer because even smaller exits can be really needle movers for folks. And it's not to be undervalued how much it forces discipline, right? And how you spend money, how you spend your time. Resource constraints bring the best out of us. The one downside, we've always kind of had a rule of thumb that when you bootstrap a business, you basically add 1 to 2 years to the growth curve. So that's not based on any science, just intuition on what we experienced. So you might be in year 5 where you would have been in year 3 with capital. So it slows you down, but there's some math in there somewhere for owning more and the relative trade-off. For those who are really thinking about this, I never promote my book. I'm the worst at that. I don't care. But there's a section in the front of my book that everyone on this topic should read. I feel like this is my one intellectual contribution to this line of thinking, where I developed a 2x2, which helps people evaluate whether or not they should bootstrap or raise venture capital. And the argument is that about 99% of the people should be out there bootstrapping or finding alternative sources of capital, and about 99% are chasing venture. So there's a complete misalignment. And my hope is we will look at that 2x2. They kind of find a way, see where they really belong and play the cards a little bit differently. Great topic. Thank you for muscling through that, Phuong.
Yeah, thank you. It was a fun topic to think about.
All right, Mike, what's up, buddy?
What's up, man? That's what Deepan used to say.
He did used to say that. Probably still does.
Throwback. Probably still does.
Yeah.
I hope he still does.
Yeah.
What's up? I'm fresh off a trip to Bogota.
How was
caught
it?
up with a portfolio company of ours called Chipper. It was great.
Mm-hmm.
Bogota's a really cool city. There's a lot of startup activity there. Obviously, that's where Rappi came from, and kind of the entrepreneurial bug that was seeded there through the Rappi team has emanated out into a bunch of really cool companies and what's a very vibrant, fun, cool Latin American city. So great trip. Good to get back down to the region, see the team, and we had a good time.
Yeah, LATAM is awake. Right, you've got the Colombia, Mexico, Brazil kind of triumvirate going now. Where people
well, Colombia's awake in company building. It's asleep in fundraising. If you think the drawdowns here in the U.S. have been large, it's multiplied down there in terms of available capital to the region. So it seems like the flight to quality has continued. And I think when people think quality, it's not just business metrics, it's also region that the business operates in.
For sure. It's a challenge for investors. We see a lot of companies coming up from other geographies, and governance, laws, exit environment, acquirers, follow-on capital are all forms of risk that are outside of the company and the business concept and the team that are real.
Yeah. And we've seen LATAM kind of cycle through, exacerbated versions of the US market for a number of, probably decades now in terms of venture growth. I think this time will be different because you've got so many good established businesses in the space. And, looking at Chipper, they're best in class. So if you look at the global landscape of B2B marketplaces focused on, servicing corner stores, that business model exists in most regions of the world now. There's one in India, there's one in Latin America, which is Chipper. There's one in Africa. Like, you see this model getting replicated all over the world right now because it's a real problem in these countries. And I think Chipper is best in class in that. So, I think in terms of flight to quality, I think we've got the winner there, but it's still, it's a tough market for these emerging markets to raise capital.
Yeah. Well, it's a long game building a venture ecosystem, but I imagine a couple decades out, there'll be more capital, more depth, more institutional money, more understanding for the rest of the ecosystem to get behind it. Yeah, I'm glad it was a good trip. What do you want to hit today?
Yeah, I think we can expand on that topic. I mean, it's something that I saw firsthand, in the board meeting this week, and I think is kind of broadly applicable across the ecosystem now. And I think a good place to start is there's a Crunchbase article from Crunchbase News about 2 weeks ago now saying Series C funding to U.S. companies by year. The title of the article was "Series C isn't what it used to be," which I thought was fairly clever. The high level is 2021 obviously peaked for Series C funding, and I'm using Series C as just like a guideline for like growth. It's sort of like the for some companies like the true like growth round, sort of pre-IPO or growth round. 2021 we saw 50 billion of funding. 2020 for context was 23 billion. 2022 reset to about 2020's numbers, so we got to 28 billion or so. 2023 now is 2.5 billion year to date, so it's on track to do 60% less than 2022 number, which is a significant recalibration in the market. So the way I think about this is, if you think that 2022 was the correction back to 2020 levels, 2023, a lot of people were like, will we bounce back? The answer is, not only have we not bounced back, but funding looks like it'll be down at this growth stage mark by about 60%. So well below 2019 levels.
Why do you, obviously the market got haywire. Why is Series C down 60 specifically? What's your sense of it?
Yeah, I think what we're seeing in the market now is an incredible flight to quality. So a lot of people have said, oh, there's so much dry powder, there's so much this and that. Like, growth stage investors are not doing a deal unless it fits the exact wheelhouse that they're looking for, and that the metrics are perfect, the growth is perfect, they're probably profitable at this point, or very close to be profitable. And the available universe of those companies is small. And the really good ones don't want to raise right now if they don't need to, because they think that marks will be poor. So a confluence of not that many companies in the space actually meet the criteria, plus companies in the space that do meet the criteria are like, why would we go to market right now? They could go raise venture debt. Maybe insiders are padding with some capital we didn't hear about, or they're just like, we'll ride it out. And then I know we've got a bunch of companies in our portfolio that fit that criteria, where in any other market, they would have raised another round to either continue growing faster or shore up the balance sheet. Instead, they've chosen to grow slower and just not test the market right now because they know marks are not going to be good.
I just came back from giving a talk to a bunch of Series B-ish Canadian entrepreneurs, and they're doing a tour through New York and Palo Alto to meet other folks and learn and swap notes. And the question came up, like, how would you characterize early stage versus growth? And I said, one of the big differences is in early stage, you're chasing the VCs. It's not quite right, but in growth, the VCs are chasing you a little bit. And it's because companies have more options. They're default to live. They're easy to raise money from internal investors. They've got real businesses. Now, if they're garbage businesses, that's a different issue, but they're not getting funded anyway in this market. But the real businesses have a greater degree of optionality on not taking down capital. So not a totally surprising stat. And we've seen that too internally. I mean, we have seen a real contraction of valuations, deal terms in the growth stage. I think it is a great time to be investing in that market. You have to be a bit of a contrarian if you want to make money. So this is a buyer's market in my mind.
Yeah, agreed. And I think the great founders know that like a mark to market is not the end of the line. So if you raise your last round at 200 or 250, right, and it was a crazy round led by, we won't name names, firms, but firms that were marking up companies out of whack. If you need more capital and you have to just recognize, hey, you know what, we'll raise 20 on 100 right now, might be half the price per share of the previous round, but as long as you manage dilution appropriately, it really shouldn't matter for your long-term outcome in the business, right? It's just a mark to market on your stock price. It's not an exit. So get the capital, keep building, and realize that markets go up, markets go down. Your job as founders to make sure the business survives. And surviving might mean just recognizing, hey, we're not worth what we were 2 years ago in the market. But going out to VC saying, hey, we want a flat round, like that's a bad signal. And it shows investors that you're not aware of market dynamics, which shows investors, especially myself, and I know you as well, that you're not as competent at running a show as we would like to see for someone that we want to invest in. So for founders out there, understand the market dynamic, go out, raise the money that you need. You don't have to overcapitalize businesses, but also be realistic that the price of yesterday is not the price of today. And that's okay.
Welcome back to New York, Mikey. Glad to have you here.
Yeah. Later.
So I'm probably the only VC, I'm sure that's an overstatement, that thinks a lot of people should be bootstrapping their companies, meaning I shouldn't be part of the deal and we shouldn't be cut in to fund your business. Bootstrapping is a terrific way to build a business. It requires a little more patience, but it builds really strong companies. I think the key to know is that if you have a really large market that you can go after and you have an incentive to grab land in that market quickly, that's when you for sure want to be raising venture capital. There are a lot of businesses that build barriers with scale, particularly businesses with network effects. There's a time when raising venture capital is a disadvantage because you end up just owning less of a small pie because you got it wrong. And there's a time when not raising capital is going to set you off to the point where someone else is going to run by you. The key is to find alignment between the business strategy and your capital strategy. And if you're bored and or interested in that, check out the first 30 pages of my book, The Fundraising Rules, which you can find on Amazon. Peace out.